It is legally possible for a company to sell 0 products this month, yet still watch its reported profit climb on the official financial statements. The driver behind this distortion is the nature of fixed costs. These are the mandatory bills, factory rent, equipment insurance, and management salaries that a company must pay regardless of whether they build one single unit or 1 million. The central dilemma for any manufacturer is deciding where to record these unavoidable, massive costs on their balance sheet. How a company chooses to account for those monthly bills dictates whether it appears to be thriving or facing bankruptcy on paper. The first method for handling these costs is called absorption costing. It is the accounting standard required for external reporting to tax authorities and investors. Under this rule, massive bills like factory rent are shattered into tiny fractions. Every unit produced absorbs a sliver of that overhead, transforming it into a physical product cost. That cost is removed from current expenses and stored in the warehouse. Under this rule, the act of manufacturing moves the fixed cost off the income statement, deferring it into inventory until the product is sold. To see how this can be manipulated, consider the math. If your factory rent is $100,000 and you produce 1,000 units, each unit absorbs $100 of that rent. But if you overproduce 10,000 units, each unit only absorbs $10 of rent. If those 10,000 units sit unsold, those deferred rent costs remain on the warehouse shelves, completely bypassing the income statement. Because the rent is hiding in the inventory, the recognized expenses for that month drop significantly. When the reported expenses drop, the reported net profit for the period increases. By overproducing inventory that nobody bought, a company can report strong earnings to shareholders without possessing the actual cash to pay its real-world bills. The catch is that this system relies on predictions. Companies have to guess their total fixed costs and their production volume a year in advance to calculate how much overhead each product should carry. But if reality differs from the budget and the factory produces fewer units than predicted, the company faces underabsorbed overheads. The company still has to pay the full rent, but because there aren't enough physical products to carry the cost, that unabsorbed portion must be taken as an immediate expense. This mismatch between the budget and actual production creates a surprise expense that reduces the reported profit. To see past these distortions, management often uses a second rulebook for internal decisions, marginal costing. In this method, fixed costs are stripped away from the products. The only costs attached are variable expenses, like raw materials. Fixed costs do not follow products into the warehouse. Instead, they hit the income statement the moment they are incurred, regardless of units produced. Because fixed costs are expensed immediately, profit moves only when products are actually sold. This makes it impossible to inflate earnings by simply building more inventory. These two methods create different incentives. Marginal costing ties profit to sales, while absorption costing ties profit to production. This means a CEO judged solely by absorption costing has a reason to keep the factory running 24/7 at year-end, solely to hide overhead costs in unsold boxes. This behavior can trigger executive bonuses based on reported profit, even while it drains the company's cash to build inventory that may never be sold. Using tax-compliant metrics to make internal operational decisions often leads to misaligned incentives and financial instability. The law requires the absorption costing rulebook for external reporting to the public and the government, but behind closed doors, to set prices and manage the actual health of the business, companies rely on the marginal costing rulebook. Absorption costing is designed for external compliance. Marginal costing is designed for internal reality. True financial literacy requires knowing which rulebook is being used before you trust the bottom line.